Another roller coaster week on Dalal Street. The Nifty is down about 1% this week, giving up all of the last week's gains. Mid-caps fared slightly worse. The mid-cap index is down almost 3% for the week. Will the Indian market continue to dance to global tunes? And of course, what about Trump's tariff threats? What's the latest? Hello and welcome to Editors Roundtable. I'm Surabhi Upadhyay, and as always with me are Nimesh as well as Nigel. And today we have a very special guest joining us to bring in the holy festivities in the studio. We have Jeffrey India Managing Director and Head of Research, Mahesh Nadurkar. Mahesh, what a pleasure to have you here. First of all, let the market be whatever it is, but happy Holi and season's greetings to you.
Thanks for having me here, and happy Holi to all of you guys.
It's a good debut to get him on a
you've cheered up our moods. We're excited, and even more because you're here with us now to wrap up the week.
Also because he's a little bullish on the markets now after the correction.
That's true.
He's turned a bit constructive, so it's better that we have a voice like him when there is so much of panic in the market. So good to have you, Mahesh.
Thank you.
Good to have you on Editors Roundtable, Mahesh. Tell us how you're feeling about the markets. I've read a couple of your notes, and you're sounding a little bit more optimistic, right? And post this pullback, obviously risk reward could be a little bit more favorable. So your take, give and take everything, the global uncertainty, the big, the bullish, everyone got very bullish on the US, and suddenly that's not really playing out. So how do you see things pan out, particularly for an emerging market like India?
No, I think the way I'm putting it is the much needed market correction is, I think, now behind us.
Okay.
I think the correction was both much needed because I think at one level the valuations had gone up way ahead, of what the fundamentals really warranted. The fundamentals were great, obviously, and even today it's not that bad. I think there is, looking at the markets, people feel that fundamentals are also very bad because that's how the market reflexivity and psychology work. But things were never that great earlier on. And it's not that bad today.
Right.
So I think we are somewhere in between, and I think markets have probably factored in, or let's say factored down towards the lower and more realistic level, both on the valuation front, on the relative performance front. And my personal belief is that, even if you look at not just the broader market, broader market valuations are down to their last 10-year averages. But even if you look at the individual stock levels, so out of the 200 plus stocks that we cover, there are about 100 stocks now that are trading at or below last 10-year averages. So it's not just the overall index level thing that I'm talking about, but even at an individual stock level as well.
Is that the primary reason? Because you made a big statement, and I think our viewers will absolutely love it, because you said you feel that after 5 months, this correction is probably over. So is that argument, the valuation argument, the primary reason that's giving you that confidence now?
Yes, valuation is definitely one.
Okay.
As I mentioned, we are down towards the long-term averages. Also, I feel that from the fundamental basis as well, things are showing signs of improvement. In the sense that, see, in the first half of the financial year, FY25, we saw two big things weighing down on the economic fundamentals, right? One is that the timing of the government expenditure. The first half, the government expenditure was down roughly about 2% to 3% on a year-on-year basis, excluding interest payments. The second half, just mathematically speaking, and if you look at the revised numbers, it's going to be up about 14-15% on a year-on-year basis. And the number that I'm talking about is almost 10% of GDP. So a 15% swing on a 10% GDP itself brings in like 150 basis point of GDP from first half to second half. That's point number one.
Right.
And the second equally big point is that over the last, say, 1 year or so, and primarily that story played out in the calendar 25, the credit growth in the banking system slowed down from 16-17% about a year ago to about 10-11%. And it was, more to do with what was happening in the banking sector, the regulatory pressures and so on. And I feel that a large part of that regulatory pressure is now behind us. RBI has turned very, very constructive, very, very focused on improving liquidity. And I think the credit growth, deposit growth numbers both have bottomed out as well. So these are the two primary reasons that which have turned favorable. And I think that is showing up in a variety of high-frequency data as well.
Okay. Speaking of data points, before we get to more questions, a very quick recap of what we saw this week. It wasn't a bad week for the market. Given the global volatility and the bad global headlines, India managed to kind of hold its ground. And yes, Friday, or rather Thursday, it was a truncated week. Thursday was a little weak. But if you look at the overall tally for the week gone by, Nifty is down just about 0.8%, 0.7, 0.8%. Mid-cap index is down more. It's down about 2.2%. The small-cap index, yes, there's some pain still there because it's down almost 4%. Now, then why am I saying it's not such a bad week, at least at the headline index level? Couple of factors. Number one, the consolidation zone was about just 300, 350 points on the Nifty, and we didn't breach the downside too often. 22,300 was not breached by the Nifty frequently. Of course, we couldn't get to the 20 DMA. That's a different argument. The other thing is that look at the extreme volatility and news flow that was being thrown at us. The US market is asking itself a very deep question now. Questions around stagflation, questions around is there a recession coming, whether tariffs are really going to break the back of the US bull market. So they're dealing with very serious issues. In the face of all of that, considering we've seen a lot of selling perhaps already in the last 5 months, India did better off. The other positive point is FPI selling. Almost every single day, barring the day we had the industry incident, FPI sell numbers have reduced day after day. So that's a great sort of point to note as well. And even the incident, that stock is down 27, 28% for the week. It didn't break the confidence in the banking and financial space overall. In fact, the Bank Nifty is not the biggest sort of down-falling index for the week at all. There was selective buying in names like ICICI Bank and HDFC Bank through the week, which also gets me to the final point why I'm saying it's not such a bad week. Look at the internals. That's what our guest is also pointing to. We had the double bonanza coming in of finally CPI inflation cooling off and IIP numbers looking better. Didn't really cheer the sentiment on Thursday, but not too bad. Quickly, the tally then in terms of the sectors, just to give you color. IT has lost out, and that's a talking point now. IT, the index itself is down 4.5%. Individual large cap names have fallen a lot more because people are worried about these companies that are exposed to US revenue. So that's a point of bother. The PSU Bank, the auto index, the real estate index are down about 2% or so. Metal index, considering the tariff issues, down about 1.5%. Bank Nifty down about 1%. So that's the tally for the week.
So, Mahesh, you briefly explained about the domestic things, domestic cues turning up a slight positive. Tell us about the global setup. She alluded to the fact that there is so much of noise now about a recession in US, a lot of concerns there as well. Yeah. How is the global setup looking to you, and what does this mean for emerging markets like India? Is it positive or negative?
Yeah, so the global setup has become very, very unpredictable, to say the least, and we all know the reason why. We are seeing like new announcements and new data points coming out from US like almost every day.
It's the T factor.
Yeah, but I think, if you just look at some of the broader, still fundamental data points, those have definitely changed directionally speaking, in the sense that around last year, September, when the election results in the US became public, from that time onwards, the US dollar started to strengthen quite a lot. Yeah. There was a lot of optimism around the economic growth in the US. And I think those things peaked out somewhere around mid-January, end January or something like that. And why I say that is, since then, if you see, first of all, the DXY, which is a measure of the dollar strength, right? That was at 110, now it's down to 103 level or something. Yes. So it's down 7% in the last 2 months or so. We've also seen the 10-year US yields are down by about 40, 45 basis points. The market expectations around the Fed rate cut, which was just about 20 basis points or so for the full year CY25 back then, as in like 2 months ago. Now we're talking about 75 basis point rate cut. So all of these things are related to each other. But I'm just saying that all these things are pointing towards the fact that the economic outlook in the US, the market outlook in the US, the dollar strength outlook, all three factors have weakened considerably. And what we've seen is that the US markets, which has been such a massive, strong driver for global equity markets for the last 15 years. Yeah. I mean, the weight of US markets in global indices was about 40% in 2010, 11 or something. By Jan, Feb, it had peaked out to about 65 to 67%. So 2/3 of the global market's weight was US. Which was 40% 15 years ago. And many of the global thought leaders have been calling out for that thing peaking out. And our view is that has probably peaked out.
But in that case, a peaking US equity market, will this be good news for markets like India? Yeah. Or will it be bad news? Because we've seen in the past, a mother market not doing good.
Then everybody goes down.
Then everything goes down. So in that context, is this time going to be quite different? in a sense, US peaks out, but India market and other Chinese market and a couple of other markets do well.
You know, Mahesh, normally we heard about this adage, right? That if the US catches a cold, everyone else gets pneumonia. This time around, we already had a cold. We were already pretty much unwell, right? When everyone was hale and hearty.
Yeah.
So do you think this time around it won't play in that manner? India can outperform even if the US market sees a bit of a subdued few months?
I mean, I think that's, I wouldn't say that just for Indian markets, but broadly the emerging markets, as a category, I think should do better in my view.
Okay.
Because over the last several years, the thing was that, I mean, if your home market and your home currency is doing so well, I mean, why bother going elsewhere, right? I'm much better off staying home and making, a lot of money. And it's only when the home market begins to show some signs of weakness that you would try and find some greener pastures outside. And that's already happening, by the way.
That would be a big pattern change, right? If the US market, like you're saying, just peaks out for the foreseeable future. I'm not talking weeks and months, but we're talking about longer patterns here. And other global markets, including EMs like India, they start doing well. It'll be a pretty big, significant break from pattern. And you see that happening.
I think that will be a big change of pattern, because the pattern that I am talking about has existed for last 15 years. Right?
Exactly.
When, as I said, like US share went up from 40% to 65%. That's a big pattern. So it will be a big change of pattern if that happens. And I think there is a good chance that it happens.
Go India.
So, well, I wouldn't really say go India, because as you also rightly mentioned, when like big daddy market peaks out, it's not that the other markets will have like a raging bull run. That's not likely. But on a relative basis, probability is high. And we are already seeing that, by the way. So if you look at the funds flow into European funds, into Asian funds, particularly the Chinese, equity funds, that has definitely improved. So the European market, the Chinese markets have been big outperformers this year, right? And I know this year is just 2 months old. But I think it looks like it's a relatively better news for the broader emerging market as a class.
And we hope that they come back to India as well, the FIs. Well, I want to focus on 2 asset classes. I'll just go across to the wall and focus on that. I'm looking at, 2 asset classes is what we're looking at. One is the Nifty, and then it's gold. And there is a ratio that you're looking at basically between Nifty and gold. And I've just done some study with regard to history. What does it suggest? As of now, currently the ratio between Nifty to gold is around 2.75. That is, if you have 2.75 grams of gold, you could buy 1 Nifty. No, that's the broad ratio. So if you look at it in a ratio terms, or you plot it in that manner. At the peak, in September, it went to around 3.75. That is 3.75 grams of gold to buy 1 Nifty. During COVID, which is more or less that black swan event, it goes down to 2. And on the upside as well, we've seen it go to around 5 or thereabouts, if I look at the last 20, 25 years or thereabouts. So as of now, we are closer to the lower end of the range, which questions that whether or not the Nifty gold ratio, is it turning favorable? 2 charts is what I'm going to pull up for you on the screen. This is the chart of Nifty as well as gold. So both of them, come up for you. So as you can see, the blue line, that's the Nifty chart out there. And currently, if you look at it, we're at around the 22,000 mark or thereabouts. But the Nifty gold ratio, that's important. That's coming down closer to around the 2.5 odd mark. As you can see on the screen, it's coming down towards that 2.5. Currently, it's around 2.7 or thereabouts. To just plot at those points, of the gold trigger points, when in fact the Nifty gold ratio comes down to around 2.5, 2.75. These are the black dots, the red dots that come up for you on the screen. From there, invariably, the Nifty does see a bit of a good run. And as of now, we're reaching closer to that zone. So just to put it in numerical terms, well, as of now, in the past, we have seen when the Nifty goes to around 2.5 to around 2.75, we do see that more often than not, 1 year down the line, the Nifty is actually higher. So maybe we have some room on the downside, but we are reaching gradually that sweet spot of around 2.5 to 2.75. And in India, actually, the ratio between the Nifty as well as gold is quite interesting, because the total gold stock is close to around $3 trillion, while the total market capitalization here in India is close to around $4 trillion. So it's almost, pretty much close to each other. While in the global markets, we have seen that the percentage of gold, if you compare it with the market capitalization, it's not that much. So that's the interesting part. Nifty to gold ratio has come down to 2.75. Is it turning favorable? Important part. Well, Mahesh, I want to come across to you and ask you about, your take on this. Because history suggests, as I just put out that piece, that around this 2.5, 2.75, if you have 2.75 grams or 2.5 grams of gold to buy the Nifty, invariably the next 1 year has been good. Do you think we're reaching to that sort of a spot? Is there something that you track?
Yeah, it's an interesting analysis that you've put out. So to be honest with you, I hadn't really looked at it the way you're putting out. Yeah, but that gives me also like one more reason to be more optimistic. Let me put it that way. Yeah.
Okay.
So, but yeah.
Okay. Very interesting. And in India, it's particularly important because, as I said, that if you compare the total gold stock in India is around $3 trillion, and the total market capitalization is around $4 trillion. If you look at it in, say, the US markets, I think the percentage of gold stock in comparison to the market capitalization will be less than 10%. Just offhand, it may be mid-single digits or something. So just thought, noted investor, actually, Naresh Kataria, he had put this out on Twitter. And I just thought I'll build on to that point. So that's another point that I'll be tracking from here.
All right, got that. So let's take a very quick break on that note. On the other side, we want to come down to the micros and ask our guest, Mahesh, since he's quite optimistic and constructive on the market, which are the pockets which you should be building your portfolios on? Welcome back here with us on Editors Roundtable, and this week we are in conversation, as you can see, with Mahesh Nadurkar of Jefferies. And Mahesh has given us more reason to cheer. He says after 5 long, painful months, perhaps the worst of this correction is indeed over. So now let's get to the second level of it. And the question that's coming in, Mahesh, right? What to buy, how to build that long-term portfolio. Do you still like, I think real estate as a space you were quite constructive on. Tell us about the top themes right now.
Yeah, so the best risk-reward sector at this point in time, I think, is lenders, basically banks and the lending NBFCs. Sure. I think that looks like the best sort of sector from a risk-reward perspective. An ideal combination of valuations, which is actually one standard deviation below the averages. The only sector in India where the current valuations are one standard deviation below. So that gives a lot of comfort. And, as I mentioned, the fact that the RBI seems to be very constructive on improving the liquidity, which I think is a great news for the banking sector and for NBFCs as well. Because one of the biggest problems that the sector has faced over the last 1 year or so is weaker deposit growth, the pressure on LDRs, therefore forced reduction in the credit growth and so on. So I think now that part clearly seems to be behind. Did this, and
I have to ask you this, not getting into individual stocks, but did this derivative issue with one large lender, did that bother you? Because now there are reports, and even, our sister concern Money Control was reporting that it could force the regulator to open up other books and just generally do a hygiene check across the board on how derivatives are being accounted for. Your thoughts?
Yeah. That's a possibility, but I, essentially think that it's not really something that is, a very broad-based issue.
It's not a systemic issue.
It's not a systemic issue in my view. So I don't think it really impacts the whole sector, as such. That's what, our view is. And, by and large, as I said, the deposit growth begins to improve and the credit growth begins to improve as well, I think automatically the concerns on the asset quality and all that, I think, will begin to come off, in my view. So I think that looks like the best sector to own from a risk-reward perspective. Some of the other very interesting
on the flip side, a sector that you would like to avoid, and maybe you've downgraded as well, is IT. That's largely because of valuations and global concerns, or only because of global concerns?
No, both. See, the thing is, if you look at the valuations in the IT sector, they have been like on the other side of banks, which is like one standard deviation higher than the averages. And one was willing, or one was happy to pay that kind of a price because the growth outlook was fantastic, the dollar was strong, and so on and so forth. But once that factor and that tailwind goes away, the currency tailwind goes away, the growth outlook in the US becomes weaker, then I'm unwilling to pay a 25% premium to the average numbers, right? When we know that the broader market is at an average, there are 100 plus stocks which are trading at below average and so on, then then why would I pay a 20% premium? I know that the IT sector has already corrected, but even after that correction, we see that it is still about 15-18% higher And I don't really see any reason. I mean, you can always find some interesting stock ideas which could do much better than the rest of the sector.
Yes.
But at an overall sectoral level, I would still say this type of valuation I'm unwilling to pay, even after seeing the correction that we have seen.
True.
Right, and one more point, Mahesh, the globe is in a bit of a flux, so to call it, right? And that's why that could be probably one of the reasons why tech you're not too bullish on. But on metals and mining, actually, that call has worked quite well because the markets have seen a pullback. But I think a couple of stocks this year that have relatively outperformed have been stocks like Hindalco, Tariffs as well. There is that hope there's going to be some safeguard duty. Right. And a couple of the notes you'll have mentioned, right? The return ratios going by history as well. Risk reward appears favorable. So tell us that call out there, because if the global demand is going to slow down itself, then it could be on this pack. For now, it's not really showing up.
Yeah, so global demand, especially as I mentioned, like US economic growth seems to be on that, on not that great a footing. But where we're seeing an improvement is, is China.
Yeah.
We are seeing improvement in Europe. And even in the US, I mean, if you go by what Mr. Trump has been saying, he wants to focus on infrastructure. So that gives you a confidence that maybe metals probably will have a lesser negative impact. But the bigger tailwind is coming from, as I said, like Europe and US, Europe and China.
China, yes.
I mean, the Chinese property markets have also started to kind of bottom out. There's some initial signs, of that. And if you'll ask me, what is the one single biggest factor for steel demand globally, then is the Chinese housing. Ultimately. So that's one. So the portfolios that are India dedicated, and if you want to play the China recovery story, then this becomes an option for you.
Correct.
Apart from the other factors that you mentioned. And also there are other factors like the possibility of the safeguard duty, etc. And if that were to come
that will be the sweetener.
That will be the sweetener. And that can actually cause like massive, almost 20-25% EPS upgrades and EBITDA upgrades.
Yes.
What else? Other sectors that you're quite convinced on at this point?
Travel, I think, right? Travel is something that you're like hotels.
Yeah, so we
well
like discretionary consumption, which includes travel. In fact, we like autos as well.
Yeah.
Okay. We continue to like real estate. So real estate, I think, is a great long-term story. We had turned cautious on it, around the election time. But after the budget, we actually turned more constructive, on real estate once again.
By the way, today there was a large deal. Blackstone has put in a majority stake in a listed company called Departed.
Right.
So again, that shows that there is a
lot of interest,
appetite from private equity investors to put that into Indian real estate.
So select autos,
actually,
hotels.
if you'll ask me to talk about like real estate, I would say that this is one sector where the stocks have corrected massively in the last 3-4 months or so. But there have been hardly any fundamental negative news. So if you look at the corporate results, very strong pre-sales numbers, good
and strong balance sheets. Most of them are sitting on good balance sheets because they've raised cash last year.
And rather interestingly, now we've started to see some of the real estate promoters of some of the large companies. They have started buying, the stock. So that also gives a confidence that yes, things are fundamentally, quite strong there.
Quite interesting. So who knows? Maybe autos, real estate, and financials could be leaders of the new bull market as and when it starts. Any final quick thoughts? Last 10-15 seconds left.
I would say that I would also, add one more sector, power. That, is also, I think, due for a pullback, on the higher side. Because that's one sector where the power demand was weak in the first half, but there are reasons. And now we're already seeing a smart recovery
16,
there.
So generation, transmission, or distribution, which part of it would you play? Power.
So, I would rather play it like more directly, which is like generation.
Okay.
And I think also some equipment plays as well.
Okay.
Yeah.
I guess we're not out of questions, but out of time, and the long weekend awaits you as well. So Mahesh, we'll wrap it up. Thank you very much. This was a pleasure, and I hope you managed to find the time to drop in a little more frequently to our offices. Excellent conversation. Thank you so much.
Thank you very much for having me here. It was a pleasure.
And festive greetings. Have a fantastic Holi weekend.
Happy Holi to all of you guys as well.
Thank you. Thank you. Well, with that, guys, I think it's time for us as well.
Yeah.
Get the colors going. All right. Well, it's a wrap on this edition of Editors Roundtable. Many thanks for watching. Have a great Holi weekend. See you with the markets again next week.